QBI Institute presents the ABC of P&C Insurance. A is for Act of God. Act of God is an event caused by natural forces such as a tornado or earthquake, which is beyond human control. A is for actual cash value or ACV. Actual cash value is the value of an insured property at the time of loss, which takes into account depreciation and wear and tear. A is for actuary. Actuary is an insurance professional who uses statistical analysis to evaluate and predict risk. A is for adjuster. Adjuster is an insurance professional responsible for evaluating and settling claims. A is for agent. Agent is a licensed professional who sells and services insurance policies. A is for all risk. All risk is a type of insurance policy that covers all perils except those specifically excluded. B is for bodily injury. Bodily injury is physical harm or injury to a person's body. B is for broker. Broker is a licensed professional who sells insurance policies on behalf of multiple insurance companies. C is for catastrophe. Catastrophe is a large-scale event that causes significant damage and loss. C is for certificate of insurance. Certificate of insurance is a document provided by an insurer that verifies the existence and coverage of an insurance policy. C is for claim. A claim is a request made to an insurance company to cover a loss or damage. C is for a claims-made policy. A claims-made policy is an insurance policy that covers claims that are made during the policy period. So even if a claimant delays filing the claim beyond the policy period, the claim will be covered. C is for combined ratio. Combined ratio is the ratio of an insurer's expenses and losses to its premiums. C is for coverage. Coverage is the scope and extent of protection provided by an insurance policy. D is for deductible. Deductible is the amount a policyholder must pay before insurance coverage takes effect. E is for endorsement. Endorsement is a change or addition made to an existing insurance policy. E is for exclusions. Exclusions are specific situations or conditions that are not covered by an insurance. I is for indemnity. Indemnity is the principle of insurance that requires an insurer to pay the actual amount of loss or damage incurred by a policyholder. I is for insurer. Insurer is the company that issues an insurance policy and assumes the risk of loss. L is for liability. Liability is the legal responsibility for damages or losses incurred by others. L is for limits. Limits are the maximum amount of coverage provided by an insurance policy. L is for loss ratio. Loss ratio is the ratio of claims paid by an insurer compared to the premiums collected. N is for named perils. Named perils is a special type of insurance policy that covers only specifically listed perils. O is for occurrence policy. Occurrence policy is an insurance policy that covers claims that occur during the policy period, regardless when the claim is reported. P is for peril. Peril is an event or circumstance that can cause financial loss or damage. P is for policyholder, a person or an entity that owns an insurance policy. P is for the premium. Premium is the amount paid by the policyholder to the insurer to maintain coverage. P is for property damage. Property damage is the physical harm or destruction to property. P is for pro rata. Pro rata is a method used to determine the amount of insurance coverage provided based on the amount of time the policy was in effect. R is for reinsurance. Reinsurance is the transfer of risk from one insurer to another. R is for replacement cost. Replacement cost is the cost to replace an insured property with a similar item in new condition. R is for risk. Risk is the possibility of financial loss or damage. R is for risk management. Risk management is the process of identifying, evaluating, and controlling risks. S is for salvage. Salvage is the process of selling damaged or destroyed property to recover some of the losses incurred by an insurer. S is for subrogation. Subrogation is the right of an insurer to recover damages paid to a policyholder from a third party who is responsible for the loss. U is for umbrella policy. An umbrella policy is an insurance policy that provides additional liability coverage beyond the limits of other policies. U is for underwriting. Underwriting is the process of evaluating and determining the level of risk associated with insuring a person or entity. V is for valuation. Valuation is the process of determining the value of an insured property or an asset. W is for waiver. Waiver is the relinquishment of a right or claim, such as the right to pursue legal action against an insurer policy. Thank you for watching QBI Institute video on property and casualty insurance vocabulary. Hope you enjoyed.